Hello, I am Rahul Sharad Joshi, Assistant Professor at the Department of Commerce, and the subject I have chosen for today is financial market operations, and the topic would be Indian financial system. Now, let us go through what we are going to study. We are going to take care of historical background, then overview of Indian financial system would be there, then formal and informal markets, then economic growth, role in economic growth, and Indian financial sector reforms. Now, the first one is, it is unit 1 of financial market operations. Now, meaning of financial system. Now, the meaning of financial system is basically the financial system includes complex of institutions and mechanism which affects the generation of savings and their transfer to those who will invest it. The critical words here are generation of savings and transfer to those who will invest. In other words, financial system may be said to be made of all those channels through which savings becomes available for investment. So, the crux is how we can generate savings and where to invest them. Then we come to roles of financial market. Roles of financial market can be bifurcated into all these things. What role a financial market plays? So, number 1, it serves as a link between the savers and investors. Then it provides a mechanism for controlling the risk. Then it helps in lowering the cost of transactions. Then it promotes capital formation, a critical important thing, it promotes capital formation. Then it assists in the selection of the projects which are to be financed, and it reviews their performance, and also it provides a payment mechanism for exchange of goods and services. These are all roles of a financial market. Then we come to components of financial system. We have 4 components of financial system to start with. First one is the financial institution. Now, what does a financial institution does? These are those institutions which mobilize and transfer the savings from surplus units to deficit units. This is the work of a financial institutions. Then we come to financial instruments. Now, financial instruments includes shares, bonds, preference shares and debentures. This is the second component of financial system. Then we come to financial services. Now, when we come to financial services includes services of a merchant banker, underwriter, brokerage and credit rating. These services helps not only to raise the required fund, but they also ensure the effective utilization of the funds. Then we come to financial market. Now, this is a place or a mechanism which facilitates the exchange of financial assets. These are the 4 components of financial system. Then we come to Indian financial system, and when we talk about Indian financial system, the first one is the pre-planned period. What were the characteristics of an Indian financial system during the pre-planned period? We have noted down the characteristics. Now, just let us go to them. In the pre-planned period, it was a family character of entrepreneurship, more of a family business was into existence. Semi-organized and narrow securities market, security market as we are seeing it today, it was not developed during those stages. Then lack of issuing institution, not many institutions were there for issuing the securities. Then absence of financial intermediaries, there were no financial intermediaries in between which will take the money out of the deficit units and provide to surplus units. Then non-responsive to opportunities, opportunities were not tapped properly. Then stock exchange had very few securities being traded in the market. It was not a market which is like today it is developed. During those days there were very few securities which used to be traded in the stock market. Then no separate issuing institution, and the last one is outside saving was restricted only to industries. No home saving used to be taken out. Then secondly, we come to mixed economy based plan period. In this the main criteria was government ownership of the financial institutions. Now, what all government ownership of financial institution means? There was nationalization of RBI in the year 1948, SBI was set up in 1956, and 14 major commercial banks were nationalized in 1969, and 6 other commercial banks were nationalized in 1980. So, during the mixed economy period we can see that nationalization took place. And then another thing was investor protection. For investor protection, many enactments came into picture. We start with Companies Act of 1956 was there, then Capital Issue Control Act was there, but now it has been replaced by SEBI. Then it was Security Contract Regulation Act of 1956, then there was FERA, Foreign Exchange Regulation Act, but now it is replaced with FEMA. Now we have FEMA in place of FERA. Then the third one is nature of financial system before liberalization. Now, We have bifurcated into 5 parts. First is the institutional structure. Institutional structure includes commercial banks, LIC, GIC and UTI. They obtain their resources by mobilizing savings from the savings surplus units and transferring them to the deficit units. Then we have distributive mechanism, development financial institutions were the primary distributors of the finance and credit to industrial enterprises. Then form of financing, majority of the funding was done in the form of debts. So, there was less of equity financing and more of debt financing. We have the problems of small and new enterprises. One of the major problem of the financial system was inability to meet the need of the small and medium sector enterprises. Majority of the funding was done to the huge industries. Then we have new market organization, there was lack of underwriting facility, no broker houses were there. So, there was lack of funding to markets. Then we come to functions of financial market. Functions of financial market we have distributed into 2 parts, one is economic functions and the other one is financial functions. When we talk about economic functions, we have it facilitates the transfer of resources from lenders to ultimate borrowers. Then lenders also earn interest on dividends of the fund which they have given. Then borrowers will have access to borrowed money, that is they will have capital with them. Then there will be a channel of capital formation and it reduces the search and information cost of transaction. These are the economic functions. When we now we come to financial functions. In financial functions, it provides the borrower with the funds which they need to carry out their plans. Then we have lenders are capable of earning without the necessity of direct ownership. They lend and they earn interest on the amount which they have given without having the direct ownership over the projects. Then it provides liquidity to the securities. We have a market. We have a ready market for securities where people are buying and selling. So, there is a liquidity component available to the borrowers. Then we have classification of the financial market. Then when we talk about classification, we have classified into 3 parts. First is the primary market, then the secondary market and then the money market. Primary market means it deals with the new issue of securities. When a company comes for the first time in the market to raise the money, that is known as primary market. Now, in secondary market, the common name of secondary market is the stock exchange where securities are listed and they are continuously traded, that is secondary market. And then money market is a place where short term investments or which mature within 1 year, they come under this category. So, classification are 3 classifications: primary market, secondary market and money market. Then we come to most important thing is capital formation. Now, how does the capital formation take place? Capital formation is done in 3 steps. The first step is your savings, second is finance and the third is investment. Now, savings can be defined as excess over expenditure created by the surplus generating units. When you have more of revenue over expenditure, we can say savings takes place. Then finance is the resources which is gathered from domestic sources as well as from abroad, and investment is the process to put the savings into productive activities. So, these are the 3 activities or 3 steps with the help of which capital formation take place. Then we have the transfer process. Now, transfer process is the relationship between the savings and investment. Now, it can be divided into 3 categories. First is the surplus units, second is the deficit units and third is the neutral units. Surplus units can be defined as those where the savings are in excess of investments. Deficit units where investment exceed their savings, that would be the deficit investments, and the third is neutral where savings are equal to investments, right. So, these are the 3 categories: surplus, deficit and neutral. Surplus means where savings are in excess of investment, that is surplus. Where investment are in excess of saving, that would be deficit, and where savings and investments are equal, that would be your neutral. So, this is how the transfer process takes place. Then mobilization of savings, a financial agents would be providing the following services so as to mobilize their savings. How to mobilize savings from general public? So, first would be convenience, then second would be a lower risk and third would be expert management, right. An individual wants to invest, then he should be comfortable in investing, he should be convenient in investing, right. So, when we talk about comfortable in investing, the minimum amount should be minimum, so that even a person who is not earning that much can invest. So, for example, we have given that in India the minimum amount required for applying in an IPO is 15,000 rupees. Any individual or a retail investor having 15,000 rupees can invest in an IPO, and lower risk is benefit of diversification. You do not need to keep all your eggs in one basket, you can diversify in different asset class so as to lower your risk, that is the benefit of diversification. And then expert management is a must. Now, there are financial advisors who give you expert opinion about the investment, so that you do not take much of the risk and your investments are safe. Then we come to channelization of saving, that is same as mobilizing, it just a part of it. Then we come to formal and informal financial sectors. Now, we have differentiated between formal and informal sectors. In case of informal financial sector, what it does, it provides savings and credit facilities for small farmers in the rural areas, whereas in case of formal financial sector, it provides saving and credit facilities for large scale enterprises. Second is, procedure is very simple and informal in case of informal financial sector, whereas in case of formal financial sector, the procedure is complex and could be understood only by a educated class. Then informal groups operate at time and day which are convenient for the members. There are no such time restrictions, whereas in case of a formal, the working days and operating hours are fixed. Continuing to it, access to credit is simple and very little in case of informal, and loan application procedures are very complex when it comes to formal financial sector. The procedure for processing of loan is simple and direct in case of informal, whereas processing of loan is complex in case of the formal financial sector. Transaction costs are very low in case of informal, they are very high in case of formal, and repayment rates are very high in case of informal and they are comparatively less in case of formal. These are the major differences between the informal financial sector and the formal financial sector. That is all for today. In the next class, we will continue with the chapter. Thank you.